Well, our first guest has suggested using gold as an inflation hedge for years. Jim Grant is with us, friend of the show, editor of Grant's Interest Rate Observer, our economics editor. Michael McKee, not wanting to miss out on the fun of talking about gold and inflation as well. Jim, we'll start with you. What does this mean that gold has, in fact, entered a bear market? Does it signal a crisis?
Well, I think the only thing it truly means is that people do hate this stuff. The rest of it is surmise. Now, there's a distinction to be drawn between a panic in which the only cause is really the structure of the marketplace, and a crash in which the collapsing asset class portends something about the future. 1987, the stocks crashed down, 25% or so in one day.
Right.
It signified nothing except that the market was poorly structured, just with respect to portfolio insurance. The bond market crashed in 1994. But still intact was a long-term decline in interest rates. It seems to me that what is intact at the moment is the determination of central banks to print their way out of trouble, which is terrifically bullish for gold over the long term. So I remain bullish, though chagrined.
Okay, bullish, though chagrined. Michael, how do you see this as fitting in with what we've all been talking about, the central banks doing these kind of unprecedented help packages and basically, as Jim just said, printing money?
Well, the latest economic fundamentals suggest that the economy is still weak. The Fed is going to remain in the game. And even those who were talking about scaling back on QE, doing some tapering, aren't talking about it until the middle of the year or later. So it doesn't seem like there's a real connection between that and what's happening to the gold price right now, nor does it seem to be a connection to inflation, because at this point, inflation is relatively stable. We're likely to see in the CPI tomorrow a drop driven by oil prices, but that's been very volatile. If you take oil prices out, inflation's been basically stable over the last year or so, whereas gold prices have not. They've been coming down since October.
Deirdre, I would say that gold is not so much a hedge against inflation as it is against monetary disorder.
I know you've called it not quite the fear trade before. You said it's the fatigue trade.
Well, it seems to me it's an investment in historical destiny, the destiny of money-spending central banks to debase those currencies. So what we have today is are poorly capitalized and poorly managed and cartelized mega financial institutions the world over. We have in China a regime that is creating credit at the annual rate of 47%, and we have in Japan a central bank that has announced that it will create yen at the equivalent of, in GDP terms, of like $190 billion a month if it were the United States. We do $85 billion a month. They are doing the equivalent in their economy of 190. And in this backdrop, it seems to me that to be bearish on gold, it might be the fact, the trade. It might be the trade. But to be bearish on it, you really have to believe that the central bankers are for once going to figure it out and do something in time.
But your argument would make more sense if gold prices were crashing up at this kind of rate. They're going down. It doesn't seem like there's a lot of fear, certainly among institutional investors, that there is this monetary disorder out there.
Well, the institutional investing community was utterly sanguine in the summer of 2007. As Mr. Morgan himself said, Michael, markets fluctuate. And this is, for the gold bull, it's vexing and trying and dispiriting. I felt so much smarter and richer last week than I do this week, Deirdre.
All right, well, we're going to time your appearances better, Jim. But I want to ask, because you mentioned China, you mentioned Asia, and a lot of people, at least if you were on Twitter or you were blogging, you saw a lot of people when gold first started to drop, Michael, talking about the fact that China's growth came in a little bit under what was expected, but it's still 7.7% growth.
It's still 7.7% growth, and really it's within the range of what people were expecting. It's a new normal growth rate there. We're not going to see the double digits, but gold doesn't have anything to do with the rate of growth in China. It may have something to do with the rate of credit creation, but right now China's not creating the kind of reserves that changed currency values that led to people holding more gold.
But the reserves are reaccelerating to the upside, so China...
But they haven't, though. The reserves at this point are staying flat.
They are. They're going a lot. It's true.
Yeah, well, it's true that we don't have an exceptionally clear read, do we, out of the economic data that comes out of China?
No, nor do the Chinese, except the ones who make it up.
Okay, well, fair enough.
Make them up.
Make them up.
Data are plural.
So you still say, listen, gold is still an inflation hedge, and one day this will come.
Well, it is a hedge against the seeming inevitability, to me, the inevitability of the collapse of what one might call the PhD standard. We had the gold standard. We've had variants on that. And now we have the purely discretionary regime of our credentialed central bankers improvising, as the chairman of the Fed said himself last summer, learning by doing. That is the standard in place. And I say that it is not one for the ages, and that the successor standard will have something to do with objective and permanent value.
Jim Grant is back with us. He is the editor of Grant's Interest Rate Observer, of course, and we are focused on inflation. Hard not to be when you see gold prices where they are, on average 2% over the past 5 years. But we just want to read a little bit from a blog posting. Paul Krugman writing earlier this morning, the gold bug inflationista view, I think he made that word up, but that's all right, of the world, says that we need to stop all efforts at monetary and fiscal stimulus, lest we turn into Weimar, is in fact all wrong. So on that point, we are going to bring in Jim. So Jim, okay, that's Mr. Krugman's point of view.
Well,
He's saying don't panic,
This is
right?
the willful obscuring of distinctions and of nuance and argument. And this man is a Nobel Prize winner. So we're not saying that this necessarily leads to Weimar. What I am saying is that is this radical, unprecedented, indeed unimagined monetary emission is distorting the things that markets value and weigh. For example, interest rates the world over have collapsed. Now, what this does, among other things, is to take credit analysis out of the picture as a useful undertaking. Why bother to study differences in credit when everything is priced at 2 or 3%? So, and in money market mutual funds, everything is priced at 0.
It's like that old Crazy Eddie commercial, right?
So,
everything is $9.99.
Right. So, because there is no profit in analyzing credit, people commit capital to the wrong places, and pretty soon you come up with a credit crisis, of which we have had many in recent memory. That's one problem with these truly radical monetary policies being followed the world over. Another problem is that they distort the meaning of money. Now, money is meant, I say, to be a store of the value of work. It is no longer that. It is a tool for the manipulation of economies. And to insist that this will work out is to ignore the massed evidence of central bank error over the preceding 5, 10, 15, 20 years. These people, well-meaning and well-educated as they are, cannot see anything coming until it hits them between the eyes.
Do you think there's any possibility that gold selling off today is caused that maybe Cyprus or some other weaker country might be looking to sell its gold reserves to try to get itself out of a hole? I mean, there's a million possibilities.
There are a million possibilities, and I think one more immediate and plausible possibility is the sheer weight of selling pressure and momentum in a market for a commodity, for a monetary medium that is, after all, without earnings, yield. Gold is a price. It is an outlook on the world. Now, the reason to be bearish on gold would be that you have utter confidence in the capacity of the central bankers of Japan, China, the United States, Europe, to dexterously manipulate those things they manipulate to press interest rates to the floor only for so long, not a fiscal quarter too long, and to remove everything that's excess come the moment when it should be removed. That's the bearish case on gold.
And you're saying basically there's absolutely no central banker that has this kind of crystal ball, which is a fair point.
No one has, including those of us who criticize central bankers, but certainly no central banker has proven his or her capacity to see into the future and improve it before it comes to pass, which, however, is the affect that they bring to the world.
Although, what else are they going to do, really, Jim? Right?
Do less.
Right.
What they should do, I say, is at least to give market-determined prices a chance to operate. In Japan is a perfect case study of what everybody else is doing, but higher, faster, and louder. So the Japanese central bank is buying real estate investment trusts. It's buying exchange-traded funds as well as bonds uncounted and unimagined. And wouldn't it be better if, instead of doing that, our central bankers would let asset prices reflect what is going on in the real economy, rather than telling us we're rich because stock prices are up, we make them go up? How about letting stock prices go up because the underlying economic activity?
Well, there's also a subsidy, right, as far as trading partners go, and this is all factoring into this decision.
And there are terrific inequities, too. Who gets the first crack at this money? Well, it's Goldman Sachs and SocGen and Citibank and all the banks that, except for the largesse of the taxpayers, would not be around telling us how lousy gold is.
What do you do, Jim, if you're an investor now? I know you're still a long-term gold liker. At least, I don't know if I can quite say gold.
I am indeed bullish on the stuff. As I
Okay.
say, bullish but chagrined. It seems to me that if you look around for a segment of the stock market or of the commodities markets that is truly loathed, truly out of fashion, you can't do better than gold. So if you have any contrary impulses, this is one place to begin. But I think it's the best place to begin.
Buy on sale. Jim Grant, thank you very much. Jim Grant joining us there, Grant's Interest Rate Observer.